everyone, and welcome to the O'Hare Wealth Management Weekly Update for April 9th, 2025. I'm Jerry Jones, joined by JJ O'Hare from the O'Hare Wealth Management team. We always want to welcome you in, and it has been a busy week, so we have a lot to go over, but we do want to remind you, if you have questions that we can address on this weekly call, please do not hesitate to submit those to service@oharewealth.com or text or call us at 414-644-0060. With that, we're going to dive right in. JJ, it's been a wild kind of ride.
Yeah, the audience knows this is the second time we've recorded this. Once before noon and once after.
So it has definitely not been dull. We love our jobs, even more so the last 2 weeks. With that, let's unpack our question. Are you changing course based on the surprise tariff reveal second time around?
Funny, same question, different meaning from this morning to this afternoon. So if you haven't watched the news, just a few minutes ago, the president announced a 90-day stay on tariffs for most countries with a 10% sort of global tariff. And then obviously China is going to leave those in place as the retaliatory tariffs seem to escalate. As a response, the market seems to be pretty excited about that. And I'm going to say a lot of the same things I actually said in the earlier call, but we thought it was important to update with that information.
Great.
So first and foremost, volatility. So yes, this has been a very, very volatile period, but we often have volatile periods, and they're tough to remember how volatile they were. And trying to put this back in perspective, this chart is actually from Monday, which, it's amazing how much things change. But this is the VIX. Can we zoom in on this chart in particular? The VIX is a fancy way of saying the CBOE's measurement using options of volatility in the market. And if you look at this, you'll see a couple of major spikes. The one on the very, very far right is today, well, it's Monday. And right now it's about 50, which is kind of that next major line. But 2008, 2009, that's the big one on the left-hand side there. That was the largest spike in the VIX, in the last 20 years. That was humongous. And that came right as we were bottoming. Actually, the second little peak there is March of 09. Then, of course, a few years later, you have another big spike. What is that? That's the European debt crisis. As you keep going, there's another tinier spike there. That's that's 2015. That's oil going below $20 a barrel. People basically have forgotten that one. Then there's another little spike there in 2018. That's the Fed raising rates too fast and then having to stop on Christmas. Then there's another huge spike again. That's COVID, and that's the bottom of COVID. That's March of 2020. That's the spike. Now, of course, you look a few years later when you have another big series of spikes there. It kind of came back in right around the middle of 2022. So you've got July and October there where you're double bottoming, you're down 25%. And then today, the market's down basically 19% on the open. Of course, now as of this recording, it looks like it's going to be up for the day. But yeah, it's been a wild ride. But what does it signal when you have those maximum levels of explosion and volatility? Well, oddly enough, it also means you're probably pretty close to the bottom in one way or the other. You're either a little ahead or a little behind. But in either way, it probably signals near the end. So on either side of those, if you look at any of those dates, if you bought, in the few months before or even the few months after, most of those purchases look pretty good a few years later. And speaking of a few years later, what do we think might happen? Because one of the big calls has been for a recession now because of uncertainty. And by the way, it is true, uncertainty in and of itself, by itself, can cause recessions, and that is not good. So here's what happens if you have a 10% correction. 10% correction. Now, we were just about at 20, which I can tell you right now happened to us for years until COVID. For years, people said, hey, don't worry, there's not been a 20% correction in 10 years. We should be expecting one. And I kept having to remind people we went down 19 and a half times 4 other times. And right now we're not down 20%, but we're darn close. And in a few years, somebody's going to say the same thing. Well, we never went down actually 20%. But what happens if you go down 10%? Well, 1 month later, if you do have a recession in the next year, you're down 2%. That's the dark line there. But 12 months later, you're flat. So after the market's corrected, remember, the market always looks forward. It's expecting those things. So if we are going to have a recession, we'd expect 12 months from now to be about the same level that we are today. The flip side is if we don't have a recession, Well, based on historic, we'd actually have pretty good returns over the next 3 months, over the next 6 months, and over the next 12 months. So are we fearful right now? No, this is this is going to be in our notes, but be fearful when others are happy, and be greedy when others are fearful. This is a very volatile period, and what we just got, and this is something we talked about this morning, is this last chart is this measures policy uncertainty. We talked about this last week as well, but when did we get the market to bottom? During periods of major economic policy uncertainty, right? You can see '08, there's a huge spike on the left. You can see the European debt crisis again, right? The market bottomed during COVID. And now we're expecting kind of this to be a market because we're seeing a huge spike in economic policy uncertainty. But these are indicators, right? Doesn't mean that it's for sure. I can't tell you that everything's going to go up tomorrow. But Jerry, talking to you, this is one of those key things today, and we said this earlier. We said that the policy we got was policy certain. Right. Last week we said, hey, we got policy certainty. And many clients have pointed out, well, no, it's not certain because we don't know what's going to happen. By the way, what has today taught us? Well, things can change.
Exactly.
The challenge I have is what I'm trying to tell people is, no, we actually had the worst possible certainty. That's what we got last week. Nobody expected tariffs to get much higher than that. If anything, everybody was waiting for, sort of like we waited for Jay Powell in 2018 to come to his senses and stop insisting that we needed to raise rates to fight non-existent inflation back in 2019. We were waiting for one person to come out and sort of change policy, and probably for the better. It was very unlikely they were going to make it any worse.
Right.
And that's what we finally got today, which is we got a little bit of what looks like the current policy being delayed by 90 days, and then additionally a 10% global tariff. That's a much better situation for everybody. And frankly, that was, when we walked into this, that was our worst case scenario prior to last Wednesday, was a 10% global piece. And people may remember, we were talking about this, as our estimate at the time was a 10% global tariff would result in about a 1% increase overall to PCE inflation one time. That was our anticipation back then, that we thought that was the worst case scenario. Now we've probably seen the real worst case scenario, and now the question is, what are we going to get next? Well, we've gotten a reprieve. So although we don't have full certainty, we probably have a lot more certainty than we used to. And we kind of can imagine things probably aren't going to be any worse, or the tariff levels and the negotiations won't be any worse looking than they were just a little while ago.
Yeah, ex-China. That doesn't seem to be getting any better.
Ex-China.
Right.
But people have to remember, one of the things we talk about is they're raising tariffs on us, but they don't actually buy that much stuff from us. They buy a lot of soybeans. They buy a lot of pharmaceuticals. They buy some ginseng. But it's, I think, $130 billion, which with a $30 trillion economy seems almost negligible. They don't buy a lot of things from us. And we've talked about this before with revenue. Sure, they can charge us 84%, or we can charge them 104%. But if we don't sell anything, there also won't be any tariffs.
Right.
Right? So if we don't sell them any soybeans, they're probably going to buy their soybeans from Brazil. Yeah, but the soybean tariffs they're going to collect from the United States and actually on their own consumers is going to be near zero, because they won't be coming from the United States. So it's not probably a great revenue source generator for China. Now, that being the aside, again, 11% of the entire U.S. economy is based on exports, selling things to other countries. So the retaliatory tariffs aren't as big of a deal as the import tariffs, because that really is it really slows down everybody else's ability to import. For instance, and the best example I can think of is we're from Wisconsin, and Canada for I don't know how many years now has had a 250% tariff on Wisconsin dairy products.
Yes. Mm-hmm.
But why, right? Well, the answer is very simple. Apparently, the politicians in Canada have decided that it's important to have a dairy industry in their home country. And as a result, in order to butter your bread in the morning, they've decided every Canadian should pay more for it. And they don't collect a lot of money on that tariff, because why would you buy milk at 250% the price?
You wouldn't.
Right? You wouldn't. So they don't collect a lot of money from the tariff. It's very protectionist. Right? And that's probably the example that we're seeing sort of play out with China. It's protectionist. Low tariffs, they actually do raise some revenue, right? This operates on a Laffer curve. Maybe we'll talk about that a little bit more next week. It's actually not a bad question. So for us, no, when we're looking forward now, because you always want to look forward, going through a lot of volatility. It's been a very I don't want to say scary week. It's been a net orderly uh, move,
Right.
but it's definitely put a lot of pressure on people, and it did kind of what we thought is, the Mag 7 got hurt the most. Most of the rest of the market didn't go down nearly as much. It is very important. Remember, almost half of the S&P earnings come from overseas companies, so this was a huge issue to the overall market. What are we going to see next? No, our anticipation is this the market bottom. I don't know. I can never say that for sure.
And that's what we always talk about, not trying to time the market. I think
Yeah.
there were those last weekend, I'm sure around the country, who said, hey, I want to go to cash. It looks like the sky is falling. Well, you look at that today, not a great idea. And that's why you don't do that.
And this is a great reminder. There's a chart I didn't bring, which talks about the worst days in the market are usually followed by the best days in the market. And if right now at about 2 o'clock things are on track, it might be one of the best days in market history in terms of overall growth. Well, you missed it if you couldn't take the volatility
Right.
in previous days. So because of that, again, stocks are a long-term asset. You should always be confident that things are going to be higher 5 years from now. And I guess what I would say is it's a lot easier to say today that I think things will be higher 5 years from now than it was to say even 2 months ago. And that's how you should be looking at this: is do I feel more confident that stocks will be higher 5 years from now? Our answer is unequivocally yes. I think it's probably still true. It's going to be higher level than it was 2 months ago as well.
Yes.
But yeah, I really think it's going to be higher than it will be as of today.
And as always, if you have some, nausea about the markets or you're just not quite sure, don't hesitate to reach out to the team. Fortunately for us, it looks like we're doing a good job of staying in touch with all of you because we don't get very many calls.
Yeah, not a lot this time.
And
No.
we appreciate that, but we want to remind you, if you do have a question, don't hesitate to reach out. With that, we're going to transition to our book recommendation for the month. I have a separate video out online, which you can access at any time on this book, Good Energy by Dr. Casey Means. I found it to be a phenomenal read, and you'll hear more about that if you check out the video. I believe it's going to enlighten you on a lot of things that go on in our society with regards to medication and health. So please pick that up if you can and take a look at it. Thank you for joining us today. On behalf of JJ, myself, and the rest of the O'Hare Wealth Management team, we will be here again next week. But in the meantime, once again, if you have a question, don't hesitate to reach out to us. Try to have a great day. I'm sure you will.
All right, thanks, everybody.